Everyone. My name is Indruj. I'm a partner with Direct Tax Practice of Khaitan and Company. I'll be the moderator for today's webinar. We would like to extend a very warm welcome to our audience in India and around the world. We hope everyone's healthy and safe. Thank you for taking the time to be with us today. This webinar is a joint initiative between Khaitan and Company's corporate practice and KPMG India's M&A and deal advisory practices. The webinar is titled Structuring Business Acquisitions in Indian Private M&A. The topic of the webinar is a very relatable one, something that would be of interest to anyone involved in any aspects of Indian M&A. As you know, structuring goes to the very heart of deal making and involves different aspects of aligning views of buyers and sellers and coming at the best option. In this webinar, we will talk about different structuring options. We will take you through share purchase, share transfers. We will take you through business transfers by way of slump sales. We will take you through asset transfer, also known as itemized sale. And finally, we will touch upon demergers. Each of these options have different legal and tax nuances, which ideally need to be compared to arrive at the best option. We will take you through detailing these options and also share certain practical experiences and case studies to make the learnings relatable. Finally, we will provide you with a bird's eye overview, doing a comparative of different options and also discussing pros and cons of each. Our first speaker for today is Prasenjit Chakravarti. Prasenjit is a partner in M&A corporate team of Khaitan and Company at Delhi office with over 15 years of experience. Prasenjit is a very experienced corporate lawyer with extensive experience in outbound and inbound M&A. He regularly advises domestic and international corporate clients on a wide array of transactions, including M&A, management buyouts, foreign investments, joint ventures, and strategic alliances. He regularly advises offshore clients and is also an integral part of firm's German desk. Prasenjit will be explaining various legal and regulatory aspects to be kept in mind for each of these options, and also importantly shed light on how buyers and sellers should protect their interests. Our second speaker is Nitish Poddar. Nitish is a partner in KPMG India's deal advisory practice. He's a national leader for private equity in KPMG India. Our third speaker is Rajendra Nalam. Raj is a partner in KPMG India's M&A tax practice and has over 19 years of experience specializing in transactional structuring. He also heads the Indo-Japan M&A tax practice for KPMG India. Nitish and Raj will be explaining the tax and accounting aspects, which are very often known to drive the structuring exercise. Before we start the presentation, I'll share certain housekeeping rules. The format for today's webinar will be a formal presentation followed by a Q&A session. You can ask questions at any time during the presentation or in the end during the Q&A. To ask a question, simply use the facility provided in your webinar portal. We will try to address as many questions as time permits. Any balanced questions we will answer offline. We will also be sharing a copy of today's presentation. Now, without further delay, I hand it over to Prasenjit to start the presentation.
Thank you very much, Indruj, for the very kind introduction, and a very warm welcome to everyone who has tuned into this webinar. And I really hope that you find this informative. I think before we kick off, very quick background, what really we are going to discuss. As you know, in terms of deal structuring, there are various options which are possible. What we are going to talk about at some length today is the four most commonly explored structures. The first one is really share acquisition. As the name indicates, it's really deals with buying and selling of shares. Then there is the business transfer and the asset transfer. And then, of course, the last option, which is a variant of a business transfer, that is transfer of an undertaking, but through a scheme which has to be ratified by a judicial authority, that is the National Company Law Tribunal. Let's first dive into one of the options, but before diving into that, what is critical to understand is, look, in any mergers and acquisitions which we are looking to do in India, there's a whole gamut of laws which one must be mindful of. A detailed discussion on these laws is outside the purview of today's presentation, but a very quick run through some of the laws which are very pertinent are taxation laws, including general anti-avoidance rules. So for example, if a structure is designed primarily to avoid the taxation, and really that's the sole purpose, then of course that can come under scrutiny. Similarly, foreign exchange laws, when there are buyers or sellers which are really non-residents, any share purchase transaction that has to be in consonance with the pricing regulations and other foreign exchange norms. Similarly, there are foreign direct investment rules, including sectoral caps, which one must be cognizant of. Uh, then there are corporate regulations under Companies Act 2013. So when you transfer a business undertaking, does it require, for example, share holders approval, or will a mere board approval suffice? That needs to be factored in as well. There are other attendant laws which are important. Competition Act, very quickly. Of course, if there's a notification to be made to the competition authorities, that will have a substantial impact on the timelines, especially if it's a complicated transaction having an adverse effect on the market. There are also employment laws which needs to be factored in when you talk about transferring employees from one undertaking to other. And there is, of course, the stamp duty laws, which may have a significant impact on a transaction. We will, in fact, spend some time today on stamp duty laws and employment laws as we move along and look at some of these structures. The first option we have is really the share acquisitions. Now, let me tell you, as the name indicates, a share acquisition is really, in a simplistic form, buying and selling of shares. Now, procedurally and just from a documentation standpoint, it is the most simplistic way to execute. The reason being, all you need is a share purchase agreement, and you execute the share transfer forms, have it duly stamped, and then you basically transfer the shares. Of course, when I say that, it has to be caveated by that there could be due diligence findings, which may add up to the number of condition precedents which have to be fulfilled. But that is true for any structure we are talking about. But on a standalone basis, just as a matter of documentation, is far more easier to implement. Similarly, if parties are looking to get cash, let's say Indian companies looking to raise capital, a share subscription model will be more suitable. And there we need a share subscription agreement, which will have to be stamped, and you can really follow the Companies Act process and get funds. What are some of the key features of this? First of all, you cannot cherry pick assets and liabilities. The investor, the acquirer, gets the company as a whole. So that is one factor to be kept in mind. The second factor is that the seller gets the entire purchase price in its own pocket. It's not a company which gets it, but a seller gets it, who is the seller of the shares. Now, that's the second important factor which has to be kept in mind. It also allows parties to really look at various tax treaties, tax havens through which investments can be made, on which I will request Raj from KPMG to throw some light, and also other tax ramifications which are peculiar to a share purchase acquisition.
Thank you, Prasenjit. So as he rightly introduced, there are two parts to the transaction, and there are two distinct parties with their own set of priorities. So first, let's look at what the buyer wants. So the buyer is trying to make the acquisition in the simplest possible way, and he has the option of either buying it directly or setting up an SPV, which is a special purpose vehicle, whether in India or overseas. Now the question is, why would somebody do so? Why don't they simply buy the shares? The reason is that this gives them the avenue to fund the SPV using a combination of both equity, debt, or a mixture of the two, which is a hybrid instrument. And the reason why somebody would do that would be that they would eventually want, if it's a cash-rich business with high free cash flows and already paying a high tax, they want to push down this debt into the target after buying it by way of a merger. And if they were to do that, the target's cash flows themselves can be used to repay the debt which was originally used to make the acquisition. So what this means is that the IRR, or the return on an investment for the investor, gets significantly enhanced. So while making an acquisition, how will it get funded, and how will that debt get serviced going forward? is a big part of the buyer's priority. The other aspect is that when a purchaser buys shares from a non-resident seller, in that case, the buyer is required to determine what is the amount of tax on the sale, withhold that tax, and deposit it with the government. In other words, if the transaction consideration was, say, 100 and the tax on that is 10, the buyer pays 90 to the seller and 10 he pays as tax into the government treasury. Now, if he does not do a good job of actually estimating that tax and depositing it, the buyer is liable under Indian tax laws for making good that tax shortfall. So this is a big part of the buyer's thinking as to estimate what is the seller's tax cost and how is he determining. And if there's risk around that, how is he dealing with that risk? The other aspect is when shares are acquired, the company or the target is acquired just as is, which means that all of its historical liabilities, all of its issues, litigation, it's an as is where is purchase. So he acquires all of that. So trying to figure out how to deal with that risk, estimating that risk, protecting against that risk is a very important part of the buyer's planning process. An incidental issue is that where the target has tax losses, typically under Indian tax laws, where a purchaser buys the company, and if it's a majority control deal, the historical tax losses lapse. Certain portions like unabsorbed depreciation continue, but therefore the purchaser has to be sure that going forward in future, whether these losses are available or not for set off, because that in turn determines what the free cash flows
I think we're facing some network issue. Sorry for that. As you all know, we're all working from home. I will request Prasanjit to please start with the legal aspects of business transfers, and we can come back to Raj back online. Thank you.
Sure. Thanks, Andrew. I think so. Really, moving on to option two, we have two very interesting options which we have. First is the business transfer, which can be executed on a slump sale basis and or a slump exchange basis. Now, what essentially this entails is transfer of a business undertaking from a company to another company on a for a lump sum consideration, which means aggregate consideration without allocating individual values to assets and liabilities. If you do that, then what happens is that you stand to make certain tax benefits under the Indian income tax law. So that is really what is very critical to note. What are some of the other nuances of business transfer on a slum sale basis is that so you can't cherry pick assets and liabilities, but you can exclude some liabilities or assets which are not core or integral to running of the business. But substantially, you cannot cherry pick assets and liabilities. What it also does, and when we come to the comparative analysis towards the end, we will focus more time on that. But there will have to be other documents to be executed. So besides the business transfer agreement, you will also need to have other documents like your intellectual property assignment agreement for transfer of employees, for real estate. All of those agreements will have to be separately executed. Uh, Moving on to a slight variant of it is the asset sale. Now, how is it different from this whole slum sale is that if, let's say, a buyer is interested in buying only certain assets, doesn't want to pick up the attendant liabilities, then the better option could be to just cherry pick those assets which the buyer wishes to acquire rather than buying the whole entire undertaking which may have unwanted liabilities. and then you cherry pick those, you transfer them, and of course you assume only identified assets. Of course the tax benefits may not come, but equally you weed out some of the liabilities which are there associated with the undertaking. Pretty much similar to the business transfer, you will have to execute for each assets separate documents for which it has to be transferred. For example, again, intellectual property right, you need an assignment agreement. So that essentially is what really a business transfer. And of course, bear in mind, when you pay the consideration for a slump sale, not in cash but in kind, which is shares, that is called a slump exchange. Uh, uh, Moving on to, I think, key tax considerations, I will request Raj, I hope he's got his network back, to walk us through quickly the business and asset transfer tax considerations, and maybe also quickly do a roundup on the share acquisitions.
Sure. Can you hear me clearly, Prasenjit?
Yes, I can, Raj.
All right. All right. I'm just trying to get my webcam on. Even as that happens, let me continue with the presentation itself. Similar to the way we analyzed how a buyer or a seller will look at the transaction itself, even in case of a business or an asset transfer, a buyer has several key considerations. The first one being that where a slump sale is being done, will the tax holiday that is associated with that business undertaking, let's say it's a business undertaking availing a tax holiday under Section 80IA, would that continue to be available to the acquirer post-transaction? And there is plenty of judicial precedents to support the position that the tax holiday pertains to the undertaking and not to the company. So even in a situation where you don't buy the company, but you only buy the business, the tax holiday availability should continue. The second aspect is that typically where a transaction happens in a slump sale, the business that is being acquired is acquired at a significant premium to the acquisition, to the book value. So you might have a business that is sitting at a book value of say 100, but the transaction price itself is say 500. Now, where do you allocate the remaining 400? And the position there is that the remaining 400 actually gets allocated to intangibles or goodwill. And the big question is whether such intangibles or goodwill will actually be available for tax depreciation going forward. Indruj, could you please go to the previous slide? Thank you. The third aspect is from an acquisition point of view, what funding instruments are actually used by the buyer. So the buying company can raise debt, including bank debt, where it's actually purchasing a business and not purchasing shares. And that debt can even be raised from a bank, which is actually willing to finance a transaction. The other aspect is the buyer will consider whether the acquisition vehicle, should it be a company or should it be an LLP? Now, the differences are that while an LLP does not pay any tax on dividend distribution, a company, on the other hand, though it has a lower tax rate, still pays, still there is a dividend tax that is involved. And so the acquirer has to make this trade-off where it's a resident acquirer. He wants to be sure that the dividend tax plus the lower tax rate that he is actually paying at the company level makes enough sense for him to not choose an LLP, which though the tax rate is higher, actually does not lead to any dividend taxes, because what gets distributed is a share of profit and not the dividend distribution itself.
We are again facing issues with Raj's network. Prasenjit, would you like to start with the demerger option, and Raj can cover it all up in the end?
Yes, I think yeah, no worries. I think let's do that. I think of course we'll send across the slides, so I think that will to the audience, and if we have time at the end, we will revisit some of the tax ramifications. But in the meantime, let's proceed with demerger. Now, demerger again, pretty much like a transfer of business undertaking, entails transfer of entire undertaking to another company, but under the supervision and needs the ratification of the National Company Law Tribunal. What it means, it naturally elongates the timelines, which is not the case in case of a private contract of business transfer. Here you will have to draw up the scheme, get the shareholders and creditors consent, and get any other requisite third-party consents, file the scheme with the tribunal, and after some process, the scheme would have been ratified. It would take around 8 to 10 months. Now that's a lot of time which one has to spend in order to get it. But there are certain benefits. Let's also look at why would one at all prefer a demerger scheme if one has to wait for 8 to 10 months. I think the first, I beg your pardon, the first benefit is that when it comes to transfer of licenses uh, in a private arrangement, when we talk about in the context of asset sale or business transfer, you have to approach each authority, and the authorities will take their own sweet time to take and scrutinize the applications and then grant or reject the approval. Uh, on the other hand, if you go on the back and strength of a, a sanction scheme, in case of a demerger, it substantially enhances the prospects of getting a complex approval from the regulatory authorities. So that's one benefit. However, let me say, the substantial benefit is from a tax standpoint, because this is one structure which is called tax neutral, subject to fulfillment of certain conditions. Of course, you can't cherry pick assets and liabilities like some still, but because of the tax benefit, this is a serious option for people to consider. And what better time to then hand it over back to Raj to explain why there is tax neutrality, which is possible, and share some of the insights. Raj, over to you. And hope you have
Sure,
better luck
thanks.
this time with the network. Yeah.
Thanks, Prasenjit. My Wi-Fi is clearly not helping me today, and I apologize to all of you and the entire audience out there. I'm not sure how to fix it, but let's keep going. What we could possibly do is we have some case studies on each of these structures. We'll probably do them together after we've done like the discussion around the concept. So coming back to the whole demerger structure, and then we could go to the next slide, is that a demerger allows two important things. One, it allows the business to be hived off and moved into a new entity without paying any taxes. So unlike the slump sale or an asset sale transactions we discussed earlier, a demerger helps you do the same thing without paying any taxes on the transfer. Secondly, when you actually do the exit, which is the shareholders actually want to sell the transferred business, they are able to sell the shares of the new company that has been formed with the business that's got hived off, which means the consideration goes directly to the shareholders. And what's better, the shareholders don't pay more taxes because these are new shares. The law treats it as if these were the old shares being held since the say 5 years or 10 years when they were first acquired. So they get the full benefit of it being long-term stock. They get the full benefit of the original cost, indexation step up, so on, all of that. So what are buyers looking for? Really, a buyer is trying to say that this is a transaction where I want to be very efficient with my proposal. So I want that I'm able to deliver cash to the shareholders directly and not get the money stuck in the company that's actually transferring the business. So whether it's a primary deal or a secondary deal, it offers immense flexibility in this situation. The slight downside to this is that while you get tax neutrality, you get efficiency, you have money going directly, the timelines that are involved are significantly elongated because of the need for an NCLT approval. And so that's an issue which both sides of the transaction have to get on board with. The other interesting part is that unlike a slump sale where you're unable to actually transfer the losses, or even a sale of shares where the losses can lapse, in a demerger, you're actually able to protect the tax losses that relate to this business and actually transfer it into the new entity. Now, one needs to see after that transfer, if shares get transferred, is it like a control deal and whether the losses will go at that point or not, or whether they can actually make a less than majority acquisition and then convert a convertible or move into a controlling positions after the tax losses have been used. So you get some of these advantages in a demerger. The last bit is around protection of past tax liabilities and no objection certificate. In a demerger, one needs to be watchful for any contingent liabilities and historical liabilities that actually move into the resulting company that's been hived off and newly formed. And there's also a tax no objection process that comes into play while going through the NCLT process. So the tax department actually has the opportunity to look at the whole demerger transaction and say, has this been properly structured? What are you guys really doing this for? And whether it's fair or not. And when the shareholders of the resulting company actually transfer the shares, they can take the position on they'll have to evaluate their position on their historical tax liabilities and actually procure a no objection certificate, because the buyer wants to be sure that his title to the shares is actually clear, and tomorrow the tax department can't come back and say, hey, this person sold you the shares, he didn't discharge his tax liabilities, so I want those shares back because I'll try and dispose them off and find a way to meet my tax collection requirement. So that's something to be careful about. From a seller point of view, the important thing is that the demerger is actually structured as a tax neutral transaction. What does that mean? The important thing is that there are various conditions prescribed under the Income Tax Act on how a demerger needs to be structured. So you need to transfer all assets, all liabilities. You need to make sure that shares are issued in consideration, nothing else. And the entire process does not violate any of those prescribed conditions. So this is the first important thing for a seller to do, because he's completing the demerger, so to speak, and then handing it over to the buyer. The second slightly tricky issue is around split of cost base. What this means is that if a shareholder of a company today has 100 rupees spent on buying the shares, and tomorrow this company splits into two parts because of the demerger, then what is the cost of shares in the new company? And the law says that the original cost of 100 should now get split between the two companies using a formula. Where it gets complicated is if it's a listed company and one has taken the benefit of a cost step up, where when the law introduced capital gains taxes on listed stock, they gave a provision to sort of help people not pay taxes on their historical costs. So they said the market price on Jan 31, 2018 is more or less your new cost base. So as long as you sell at that price or below, there is no tax cost. But the question is, when you formed a demerger and you've now got two companies and the cost is to be split in both cases, how does this actually get split? And whether the benefit will be available or not is a complex issue and needs a lot more study. The other issue is that a number of shareholders who are actually coming from, say, Mauritius or Singapore, or from a territory where they have tax protection on capital gains, if they get shares of a new company post demerger, will they get that tax benefit of capital gains exemption both on the original shares that they held in the company where they first invested, as well as the shares of the company where the new one has got formed? And the question or the ambiguity is because the law says that all shares existing as of 31st March 2017 will have this benefit. But we've done the demerger just now, so these shares have come into existence just now. And so the big question mark is, what happens? Do you get treaty benefit or not on this? And from a buyer and a seller point of view, this becomes a major issue around how to compute the tax withholding tax, who takes the liability, how would the indemnity work, and so on. The last part on this is about the stamp duty cost on demerger. And the stamp duty cost on demerger, basically there's a formula that speaks about how the cost should get, how stamp duty will apply in case of a demerger. And using those unique formula, you might actually end up paying far less stamp duty than you would have done had you done a conventional sale, which is like a slump sale or so. Next slide, please. So this is a transaction that we had worked on where we had a listed company with two business A and business B. The requirement for us was to transfer the business B of the listco into a private ICO, because the buyer who was actually investing into ICO did not want to come into a listed company. He wanted to come into a private company. So the question was, how are we going to move business B into a private company and yet pay part of the consideration not to listco but to the shareholders, which is like the promoters in public of listco. So we had all of these asks in one place, and what we decided to do was, let's demerge business B into ICO using a scheme of arrangement, and let's not list it. In consideration of that demerger, we can actually issue redeemable preference shares to the shareholders of listco. So you now have ICO, which is owned by listco, and RPS, redeemable preference shares, held by the shareholders of listco. The company is private, but the RPS is listed. And then we have the buyer come in and invest into this company, and that cash was used to actually redeem the RPS that were issued by ICO to the shareholders. So at the end of this, we managed to move the entire business into a private company using a demerger, which was tax-free. We got the buyer to invest into a private company. We also paid cash directly to the promoters and the public without having to route the cash through listco and paying taxes at two levels. This is a transaction that is ongoing, and we think this is a great idea if any of you are looking at a transaction with multiple aspects to it. So I'm going to hand back now to Indraj for the comparative analysis.
Thank you, Raj. That was very helpful. Maybe you can also cover the parts that got missed earlier during the comparative analysis when you're comparing different options. I will actually now request Prasenjit to discuss on the comparative analysis, and for Nitish to also add from an accounting and diligence perspective, and Raj, then you can close it again from a tax perspective.
All right.
Thank you. Thanks, Inruj, and thanks very much, Raj, for the case study and hearing the tax ramifications. I think this is the most interesting and perhaps most critical aspect of this presentation. Why I say that? Because while we have spent very brief, briefly on some of these options, unless we juxtapose each of these options and see which option fares how well or bad against the other, we will never get to know which is the right option. And therefore, we have devoted 3 to 4 slides on it. Because of want of time, we will not go through each and every option. I will urge you to read this presentation once we send it across to you. For this presentation, we will focus on 5 most critical options, which I think you should take a careful look. In my experience, invariably, these are the 5 options which will decide and determine which option to go for. The first option is the complexity. I think on that parameter, the only point I will make is that demerger, as we know, will take 8 to 10 months. If parties for commercial considerations have only 3 months to wrap up the transaction, we have to unfortunately rule out demerger. When it comes to share transfer and asset purchase and business transfer, there also share transfer, as I mentioned at the outset, is more simplistic in nature as against a business transfer or asset transfer, because the sheer number of documents you will have to enter into when it comes to an asset transfer transaction or a business transfer transaction to transfer the assets. Moving on to the next parameter is third-party consents and approvals. Now, a bulk of it will be determined through a due diligence exercise, but really what is important here to take note of is regulatory approvals. because while in case of share transfer transaction, there is no transfer of license which is happening. Possibly there may be a requirement of an approval because of change in shareholding or change in control or change in management structure. But by and large, that is more simplistic in our experience. What is more cumbersome is when you transfer a business undertaking from X to Y, and with that you have to go to a regulator and say, look, please transfer my factory license from X to Y, please transfer my environmental consent from X to Y. Now that is far more complicated. It's tedious, it's time consuming. And well, while India has climbed up the ease of business rankings, it's still number one. It's still not number one, rather. And what it means, you still have red tapeism in many levels. You will have to push through files, and you will have to spend some time, effort to get those approvals. So it's definitely far more complex when it comes to getting license and approvals. In comparison to asset sale and business transfer, a demerger, as I mentioned, because of the court sanction scheme, it's arguably a bit more simpler to get regulatory consent, because the court has already sanctioned the scheme, which is ratified by the creditors as well as the shareholders. So moving on to the third most critical aspect is past liabilities. Now, isn't it the most important consideration? Because if a company is riddled with liabilities, how will you go about acquiring the company? And that could be a make or break. Now, what do you do if a company has enormous past liabilities? And here I will just make a side point, that the significance of due diligence, because it's ultimately through extensive due diligence you can flush out liabilities, and then only you can discuss and debate the appropriate structure. Now, there are few options there. If there's substantive liabilities, you can easily do cherry picking, exclude them, live with an asset transfer. If the liabilities are not substantial, you can go for share transfer. If the liabilities are substantial, but this is not core to the business which is being transferred, you can do a slump sale and you can exclude those liabilities. But if there is a serious risk and threat of successor liability, which means the buyer inheriting the past liabilities of the seller, especially statutory liabilities like tax, provident fund, and environmental liabilities, all of this which can add up to a substantive cost, one would be better off in doing asset transfer. Uh, Moving on, I think the next point would be continuity of business, and here I will really briefly touch upon area which is very often asked. What about the transfer of employees regime? In a share transfer, there is no such issue, because the investor or the acquirer acquires the shares, and with that it acquires all the assets along with the employees of the company. However, that is not the case in case of a business transfer or asset transfer. You will have to have a separate mechanism which has to be devised in order to transfer the employees from the transferor to the transferee. In a nutshell, unlike TUPE in England, there is no concept of automatic transfer of employees with the undertaking. What you need to do is, of course, study up their employment contracts, study up the HR policies, especially for white collar employees, and for blue collar employees, look up the Industrial Disputes Act and also any collective bargaining agreements. And if there are any trade unions, of course, factor in all of that, and offer them terms which are I would say, inferior than the current terms, and you get their consent, get them to resign voluntarily and join on same or better terms in the new company. That's practically the process how it plays out. Uh, Here, a word of caution is that if there are, and I've seen, again speaking from practical experience, in one transaction there were a couple of trade unions who were taking an active interest in the transaction, and there was an imminent threat of a strike if some of the terms which they were proposing were not adhered to by the buyer. Eventually, therefore, the asset transfer didn't work out, and the parties went back to the drawing board and came to the conclusion that the share transfer would be a better option. At least you take out the trade unions out of the equation. The last factor which I would like to touch upon and has a profound impact on many transactions is stamp duty. In one transaction I can recall, in schemes, it was a perfect transaction because of tax neutrality. The demerger scheme and the route was the best option. However, when the parties did the maths, the stamp duty, which is payable not only on the scheme, but also payable on real estate, which was scattered across several cities in India, the amount came to be a staggering number. And therefore, whatever tax benefits were there, unfortunately, they were substantially outweighed by the downside of the stamp duty cost. So therefore, while stamp duty is also there in business transfer and asset transfer, because that also entails a separate conveyance deed, but there is no scheme which has to be stamped. So it's kind of a double whammy when it comes to demerger, and one must definitely weigh up all of these pros and cons very carefully with a fine-tooth comb, rather than jumping to a hasty conclusion that just because the demerger offers a tax benefit, we should do demerger. So those are 5 key options. As I said, there are other options also, so other pros and cons, which in the interest of time I will skip, but I will really urge you to take a look. With that, I will request my friends from KPMG, Nitish and Raj, to walk us through some of the accounting and tax parameters on which one can choose some of these options.
Thanks a lot, Prosenjit. So I will just take a couple of minutes to cover the accounting and financial diligence aspect, given the 4 parameters. Share acquisition and demerger, right? Share acquisition and demerger are the 2 most critical situations where you are actually buying the company along with its past liability and the whole package. And therefore, the scope of diligence in both of these situations have to be very, very extensive. It's like a full scope financial and tax diligence, because you have to be very clear of what you are entering into, right? So the scope of diligence for share acquisition and demerger has to be immense, extensive, as deep as possible. For asset transfer, depending on what the situation is, maybe you really don't need a detailed financial and accounting diligence until unless you want to understand past trends. So that's the least in terms of priority. For business transfer, it really depends in terms of what the transaction structure is, right? In many situations, what happens is only a part of the business from a larger entity is being carved out, and the business transfer is only happening for a part of the business. And in those situations, maybe because you're not taking too many of past liabilities which remain with the parent company, if I may say, but you still need to understand how will this carved out entity, operate on a standalone basis, right? So the business transfer, why the diligence is not as extensive as share acquisition and demerger. In a business transfer, the financial and accounting diligence becomes very important to get to a view on the standalone operation of that company. And therefore, it's a very special and a different type of a diligence, and not similar to what you typically do in a share acquisition and demerger. And obviously, one of the challenges that we face is, in case of a business transfer, is that the business that is being transferred, you really need to create a financial statement for that. The financial statement is not readily available, right? As against that, in case of share acquisition and demerger, financials are readily available for those businesses. In demerger, it depends actually, sorry, my bad. In demerger, it depends on whether that business that is being demerged, whether it was being run as a specific business unit, which typically is the situation in a demerger, and therefore the financials are almost readily available, right? Accounting treatment. As all of us know, share acquisition is accounted for as as an investment in our books of accounts. So if I'm the buyer and I'm buying the shares of another entity, I will account in my standalone books, I will account that as investments at the value that I've invested in. It's plain and simple. What becomes very interesting in business transfer and asset transfer is actually that you can do a purchase price allocation. You can fair value the assets that you have bought, right? So for example, if the book value of assets that you have bought is 100 rupees and you've paid 200 rupees for it, 100 rupees is goodwill, right? No, but in case of a business transfer, you can fair value the 100 rupees of assets that you have bought. In addition, you can recognize intangibles. So the entire difference between 200 and 100 need not be goodwill. It could be other intangible assets. For example, customer relationships, supplier relationships, certain IPs that you have which may not have been capitalized. All of them can be recognized as intangible and depreciable in your tax books of accounts, right? Asset transfer is plain and simple. Basically, you acquire the assets and fair value that and recognize that in your books. In case of demerger, it is completely considered as a standalone new legal entity, right, from an accounting perspective. So I will just take a pause here and I'll hand over to my colleague Raj to talk about the tax impacts and the tax comparisons for the four options. Raj?
Thanks, Nitish. So in terms of tax efficiency, really from a seller point of view, share acquisition is simple and straight. Shares are sold, cash comes into their bank account, and that's one-step taxation. In a business transfer, it could be inefficient if the company has sold a business and received the consideration, and then it has to distribute it to shareholders. So long as the company is able to use the cash for its own purposes, say to repay a bank loan or to invest it in new projects, it's no problem. But distributing it creates an additional layer of tax. Asset transfer is pretty similar to what the situation is on a business transfer. Demerger, on the other hand, is efficient because of two reasons. Number one, the transfer itself is neutral into a new company, and then when the sale happens, cash goes directly to the shareholder, which is similar to option one, which is share acquisition. In terms of step up of the depreciable tax base, share acquisition, usually there is no step up. You buy the shares, the company retains its original cost base. Yes, if there is a debt push down, there is a merger and there's creation of certain intangibles, yes, some step up could be possible. A business transfer, cost step up is possible. If the book value is 100 and you paid 500, potentially 400 can be used as depreciable tax base, subject to it being part of the list of assets that qualify for depreciation. Asset transfer is similar. What you pay is the value on which you will claim depreciation going forward. Demerger, again, no step up is possible because the cost base retains exactly what it was in the demerged company. So the resulting company is unable to claim any step up. GST liability is pretty similar across all four options, except that in asset transfer, GST will apply. In all of the others, it does not apply. With that, I'm going to hand it back to Indruj to close out.
Thank you, Raj. Thank you. I thank the speakers for that very interesting presentation. As we can see, there is no one size that fits all. All the options need to be compared with each other. There are different aspects that need to be considered. There are certain qualitative considerations such as deal complexity, time involvement, dependency on third parties, cost involved. We also have certain quantitative considerations such as income tax leakages, GST considerations, and also stamp duty. Hence, it's best to procure expert legal and tax advice to get a comprehensive structure so that it's the most efficient option. With this, we've come to the end of our presentation. We will now begin with the Q&A session. If you've not asked the questions already, you can still do so using the webinar portal facility. We already have several questions. We'll try and answer as many as time permits. On the balance, we'll get back. The first question we have here is on diligence based. So Nitish, I'll request you to please take this. The question is, how different is the diligence process between equity deal and demerger versus slump sale and asset sale?
Okay, thank you, Indruj. So let me spread out the four, right? So on an asset transfer, really, there's deep diligence not required because effectively you're buying assets and the only thing you maybe want to do is get a fair valuation of the assets done as on the date of acquisition. On demerger and on share acquisition, the diligence, as I had mentioned earlier, needs to be super extensive, right? Because effectively you're buying the company along with its past baggage, all liabilities and everything. And therefore it has to be really, really extensive because you don't want to have hidden liabilities or you don't want surprises after you've done the acquisition and closed the deal to be cropping up, right? So effectively, however, business transfer is what is tricky. Many a times people believe that because there is a BTA being done and we are not buying an existing company, there's necessarily all liabilities, past liabilities, etc. do not transfer. So there are two things. One, you have to be very, very careful about how the BTA is structured and whether there are any successor liabilities moving on. And if there is, then you should treat this as a share acquisition diligence. The second complexity that can arise on case of a BTA situation is that you're more often than not taking over the entire business, and you're taking over a part of the business, and therefore there is a BTA and a slump sale. There, to be able to get a view on what the profitability of the business that you are buying on a standalone basis would be, what the net working capital requirement of the business on a standalone basis would be, is very, very important to assess, which in the larger picture we at times sort of tend to ignore. But that is more critical. So whilst it's not a complete extensive diligence, at times BTA diligences can become far more extensive than even a share acquisition and a demerger diligence. Indruj?
Thank you, Nitish, for that helpful explanation. We'll take the next question now. This is regarding transaction documents, so I'll request Prasanjit to address this. What is the significance of transaction documents in order to bridge any gap which may have crept in owing to a difference of opinion between buyers and sellers on the ideal transaction structure? Prasanjit.
Yeah, but it's a bit of a network lag, but I guess you're talking about the significance of transaction documents to bridge any difference of views, I guess, between. So I think this is a incredibly, I think, important question, because ultimately no structure is ideal, as we know. Equally, there will be conflict between a buyer and a seller, and to reconcile them, I think transaction documents plays a pivotal role, because ultimately no party will have that much of a leverage that one can steamroll the other party and say, look, because of tax benefits you please do this, or there are past liabilities, therefore I will just do an asset sale. And more often than not, I think to have good legal advisors around, tax advisors around, what they do is craft appropriate transaction documents to bridge that gap. Now, let me put it into perspective by giving a few examples. For instance, let's talk about past liabilities. Now, if there are past liabilities and a buyer is absolutely scared that, look, a share transfer will be disastrous for it, and really it wants to do an itemized sale, and the seller says, no ways, that's not on. How do you bridge the gap? To bridge the gap is that you negotiate with the buyer, get him to do a share purchase agreement, and in the share purchase agreement you have robust set of warranties backed with indemnities, escrows and holdbacks, so that if at all liabilities do trickle down, there is a kitty to dip into in order to recoup any losses suffered. This is just one of the several options possible. The buyer can also insist on a parent guarantee if the seller's financial solvency is in question. That is also possible. But the larger point is that contractually you can ring fence and insulate yourself, and therefore a robust contract is very important. Now, moving on to another example of asset purchase. Now, let's say you move for a particular license and approval. Now, that is pending. But however, you need to close the transaction. Now, what do? If you keep on waiting for the license to come through, then the transaction will take an extended timeline to close. So what you do is have a very robust mechanism, especially a further assurance clause, where the seller promises to extend full cooperation after closing till the time the buyer obtains all the licenses, so that it can run its business as it was done prior to closing. Similarly, if there are certain, let's say, losses suffered by the buyer, you can have an escrow arrangement in place. The buyer can dip into that in order to claw back some of these losses. So net, what is very critical is to have a robust documentation in place, ironclad, watertight documents which cannot be misinterpreted, which is not ambiguous, and that's a very, very important aspect which should not be overlooked at all.
Thank you, Prasanjit. I think you very well emphasized the importance of documents and how they bridge the gap. We'll move on to the next question. This is on tax. Raj, maybe you can take this. So the question is that in case of slump exchange, while the gains may be arguably exempt from tax, can the buyer be taxed on acquiring the assets, especially when the assets involve an immovable property?
Sure. So that's a great question, by the way. So there are two sides to this. The first being what the seller is doing. But for a minute, let's put that aside and say that's not our concern, because our querist is clearly a buyer. So from the buyer's point of view, the interesting thing is that the buyer is paying in the form of stock in a slump exchange, which means the buyer has paid value. because the stock that the buyer issues represents economic ownership, it represents rights to dividend, it also represents rights at the time of liquidation. So as far as the buyer is concerned, he has paid value. Coming to the issue around immobile property, a bit of a vexed question, but I would tend to go with the view that if this is immobile property that is really an intrinsic part of the business, let's say it's factory land and it's not surplus residential land in some metro, then really this is part and parcel of the business. And this land by itself has no huge value in the market because it's always factory land. You can't build a mall or do something there. And therefore, I would go with the view that we shouldn't worry about it. The buyer has paid value in the form of stock, and the immobile property is part and parcel of a business. I would, however, urge caution where somebody is trying to transfer land or immobile property in the disguise of a business sale. There, I think there could be a high risk. So, back to you, George.
Thank you, Raj. That was a very clear answer to a very complex question and good do's and don'ts. The next question, Prasenjit, this will be back to you. Is it possible for the buyer to contractually eliminate the risk of successor liability in a business, asset transfer or demerger?
Well, I think it's a rather tricky question, and I think there is no I think largely, let me, before responding to this question, explain the doctrine of successor liability. This doctrine essentially means any historic liability of the seller which the buyer is not assuming as part of the business or asset transfer statutorily rolls over and is assumed by the buyer. Now that doctrine in many ways I would say is still evolving in India. Barring a couple of statutes, I think there's section 170 of Indian Income Tax Act, which says if a seller is not traceable or if the seller doesn't have enough assets to satisfy tax demands, the buyer of the assets will have to step in and meet those tax liabilities. Similarly, in case of provident fund, basically the pension fund in foreign countries, for past provident fund dues as well as damages, and this is following from the statute section 13B and 17B of the Provident Fund Act, there is a definite possibility that these dues can be claimed from the buyer. In fact, in 2014, there was a judgment as well of the Honorable Supreme Court, the highest court of country, in MacLeod Russell versus the Regional Provident Fund Commissioner of Jaipalguri, which categorically spelled out that for damages in connection with outstanding provident fund, you will have to, the buyer will have to step in and pay. Now, question is, what do you do about it? Can you contractually exclude it? That's the question. The answer is definitely yes. It goes back to my previous response. Actually, the significance of a watertight, ironclad contract. You should have definitely specific indemnities to mitigate and insulate yourself against any such claims. So even if in an eventuality a statutory authority chases you for a particular demand, you pay them, but at least you can claw it back from the seller. And therefore diligence is important to identify the issue. Robust agreement is required to safeguard against any such issues. If the liability is imminent, you please have an escrow arrangement, because to chase the seller for the indemnity may mean nothing if the seller has not enough financial wherewithal left. So all those drafting jugglery is very important and should definitely not be overlooked at all, as I mentioned in the previous response to previous question.
Thank you, Prasenjit. Raj, we have another tricky question for you on tax. This one says, is it possible for a non-resident to justify not being covered by deemed pricing provisions which seek to tax acquisition of shares at a discount less than fair market value?
Yeah, so I wish the answer to this was simpler than the first one. It isn't. The law itself does not distinguish. The law simply says that if shares are being acquired at a price below, then the law applies. That's it. It's as simple as that. However, questions could arise as to whether that person is even taxable in the first place and whether this provision can be legally applied. And so I would urge caution in such situations and go with the view, if I had to pick, that assume that it applies and budget for the risk, rather than take the aggressive position that it certainly doesn't apply.
Very well answered, Raj. Thank you. I'm afraid we've come to the end of our Q&A session also. We've ran out of time. Thank you for your questions. We received several other questions, and we'll certainly respond to these over an email. We hope you found this webinar interesting and a worthwhile investment of your time. We certainly enjoyed bringing it to you. If you would like to know more about any of the topics discussed today, please feel free to reach out to any of us. Our coordinates will be displayed on the screen shortly. We will also like to receive your feedback. We will put a short poll on your screen now. The poll will be available on your screen for about 30 seconds, and you can select an option by clicking it on your screen. And as everyone responds to the poll, I will also inform you that when you close this webinar, a short survey will open in your browser. We'll be grateful if you fill in that too. The poll is now closed. Thank you for your feedback. And with that, a final thank you, and we look forward to connecting again.